Stocks seesaw after a weak open as uncertainty around global growth and monetary policy actions clouds the sentiment in the market. Metals and financials trade weak while healthcare and IT show resilience.
Indus Towers has asked Vodafone Idea to pay its dues or face discontinuation of tower services, sources tell CNBC-TV18. The miss is following a board meet of the tower's major pitch for the troubled telco.
Torrent Pharma is set to acquire cosmetic derma-focused Curatio Healthcare for 2,000 crore rupees in a move that is seen as a pricey bid for a foray into a high-potential segment. The stock slips today.
Godrej Properties gains on a land deal in Bangalore. Gujarat Alkalis is boosted by new capacity. Motherson Sumi wiring perks up on hopes of a bonus issue while Supriya Life sulks after its CEO steps down.
And rupee hits a new low in step with other Asian currencies as the PBOC fixes the yuan lower than expected at 7.22 per dollar. Rise in US yields and dollar index also hits rupee and other emerging market currencies. Hello and welcome to Business Lunch. I'm Nisha Podar and with me is my co-anchor Sonal Bhutra. So let's take a look at the market action today, and quite a yo-yo movement, I would say, and every attempt has been made by the markets to really stay above the psychological level of 17,000, and it has been trying to defend it quite emphatically. But at the moment at lunch hour, we have seen some bit of steam being out of the market and it really losing ground in terms of coming back in the red at the moment. So more than 50 points down from the high point of the day, which was above 17,000 levels. At the moment, 33 points cut on Nifty 50. As far as sensex is concerned, it's lost 100 points. The financials, that's the pocket to watch out for. Bank Nifty is the one which is leading the charge in terms of the nervousness in the market because of the global cues as well as monetary policy actions and in anticipation of that along with inflation. So therefore, almost 0.5% down, inching towards that Bank Nifty. But the larger, broader market, that is the mid-cap universe, showing some bit of resilience today. 0.3% up in trade in the green, outperforming the key indices. And therefore, the advanced decline ratio and the market breadth looking also far better at the moment. Keep an eye out on some of the big heavyweights coming in, like Reliance Industries. That is a big drag on the markets along with the key financials. Sonal.
Sorry. Oh, yes, that's what's happening in the markets today. And of course, we have the monthly expiry tomorrow. So we've been talking about decoupling, and then something that we did was mirroring the global market moves as well. So for today, we are seeing markets down yet again. As Nisha was pointing out, it has been very volatile. But what has not been volatile is rupee, because that is continuously been weakening. It opened today at fresh record low of 81.9 versus US dollar. Lata Venkatesh is here to discuss if rupee will break the 82 barrier. Lata.
It's actually a double whammy now for Asian currencies. It's not anymore talking only about US yields. We have to talk about China. The Chinese currency saw a much lower fixing today. You know, Chinese currency doesn't, it's not entirely market determined. The PBOC determines a midpoint and allows the currency to float around it. The new midpoint, which everyone thought would come closer to 7.16 per dollar, which was yesterday's close, came in at 7.22, which was quite a surprise. They actually allowed or enforced a depreciation. And so all Asian currencies are showing that impact. And of course, the rupee was no exception. Right from the word go, we started off at 81.90. What dealers tell us is that there is a persistent dollar offering, which they are guessing is from the Reserve Bank. And they are guessing that because of this offer, 81.94 is not getting crossed. Also, the rupee looks like a relative outperformer because at 81.94, it is about 0.3, 0.4 lower than previous close. The Korean won is 1.25% lower than yesterday's close. The Chinese yuan itself is down 0.75 versus yesterday's close. So clearly this is, a worldwide phenomenon. And just to add, US yields overnight crossed 4%, the 10-year that is, which is a fresh 13-year high. and the US data came very robust. Consumer confidence as well as new home sales. New home sales were 28% higher than June, the July numbers, whereas they were actually expected to fall by about 0.05. So, strong noises coming from Fed governors who spoke, like Bullard and Evans as well. And therefore, the market now is not looking like there is any immediate peaking off of the dollar or bottoming out of the currency. At least for the moment, there's more to go.
All right, more to go and more to be seen in the world currency market, especially the emerging markets. Thanks, Lata, for all the details. But the three-day Monetary Policy Committee gets underway today. And with the committee really set to announce its rate decision on Friday, all eyes will be on that, given the backdrop of a highly hawkish Fed and a depreciating rupee. Now, the CNBC-TV18 Citizens MPC is expecting a 50 basis points hike to be announced on this Friday, and a possible change of even the stance will also be key to watch out for. In fact, earlier today, we got in touch with Kotak's Upasana Bhardwaj and also Barclays' Rahul Bajoria to understand their expectations from the Reserve Bank of India come Friday. Take a listen.
I think a 50 basis hike will probably manage the global and the domestic risks together. For now, I don't think this is going to be the last rate hike. I think there is room for more.
I think while there is, some comfort to be taken from the fact that commodity prices globally are coming down very quickly, and that will obviously have an impact on our inflation trajectory going forward as well. I think for this particular meeting itself, there is no real room, given the fact that inflation is still around 7%. It's likely to remain in the 7 handle in the month of September. So I think just at the moment, I think the RBI can continue to sound hawkish.
Okay, let's stay with the currency theme as the dollar index continues to hold near 2-decade highs and currencies of developed economies plummet. How have currency moves impacted the IT industry? Reema is standing by at the big wall with a complete analysis.
The rupee continues to hit record lows versus the dollar, and it's now inching towards the 82 levels. Conventional wisdom tells us that rupee depreciation benefits the Indian IT companies, and that's true. The Nifty IT index has been the best performing index this week. So we're now going to explain how the movement of the rupee versus the dollar impacts the Indian companies. Now, if I'm earning $1 in USDs, earlier when I would convert it, I would get, say, 75 rupees or 80 rupees. But now when I convert, I will get 82 rupees. So straight away, that's an added benefit for my top line on conversion. It also benefits my margins as my operating costs do not move up in the same quantum as most of my staff is based in India. But there is another angle, and it's called cross-currency, which is caused by the near 5 to 6% appreciation of the euro GBP against the dollar, and this is going to take away part of the benefit of the INR depreciation on the margin. Now I'm here to tell you how this works. Now, the Indian IT companies roughly get about 50 to 65% of their revenues from the United States. That is in US dollars. Now, if you look at the individual companies, the highest exposure is that of HCL Tech at 65%. The least is Tech Mahindra at 50%. TCS stands at 55%, while Infosys is nearly at 60%. Now, with the INR between 81 and 82 rupees, we're looking at a sharp 3% quarter-on-quarter average depreciation for the Indian currency versus the US dollar. The rate that we typically look at is the average rate for the quarter. In Q1, the average rate was about 77 rupees and 25 paise. It's now inching towards that 80 mark in the current quarter. 1% rupee depreciation is positive for the margins to the tune of about 25 to 35 basis points. So it's a significant benefit that Indian IT companies will get. But remember, the Indian IT companies also generate about 35 to 50% of their revenues in non-USD currency. Mostly it's from Europe and UK, the other two developed economies, but the other important currencies are yen, where TCS has an exposure, Australian dollar, the Canadian dollar, and these currencies have seen a very sharp fall against the US dollar. Now let me tell you how this works. Example, if I'm earning 100 euros worth of work, earlier, when I would convert it back into US dollars, I would get, say, 102, 103 euros. But now when I convert it, I'm only going to get 98 US dollars. So that's straight away a loss of about $5 worth of work. And that's called cross currency. And this happens when the euro, GBP, and all the other currencies depreciate against the dollar. And this quarter, we are likely to see significant cross currency headwinds. And this will take away part of the benefit of the INR depreciation. Yes, there will be a benefit of INR depreciation on the margins, which will reflect in the Q2 margins, but it will be partly eaten away by the cross-currency headwinds. The math is a bit complicated, to understand the net benefit, it depends on what rate the revenue is booked, how much of the revenue comes in from each of the geographies, what percentage of it is hedged, what the hedge rates are. But the moot point that we're driving at is that while optically the INR depreciation appears as a tailwind, cross-currency headwinds will ensure only a marginal tailwind for the IT companies this quarter.
All right, calculation, not that easy. Rima, thanks so much for explaining that to us. With that, we'll slip into a short breather on Business Lunch. But when we return, remember, Transport Minister Nitin Gadkari emphasizes on a focus on safety rather than cost for the electric vehicle makers. We get you more details on that when we return.
Hi, welcome back. You're still tuned into Business Lunch on CNBC-TV18. Well, insurance regulator IRDAI has pushed for insurers to offer long-term policies. My colleague Yash Jain is here to get us up to speed on the exclusive details on this. Tell us more, Yash.
Well, so this essentially way of issuing long-term policy is something which has been going on in the life insurance sector, where there are long-term policies which are issued 10 years, 15 years. The same thing is what the regulator wants to introduce on the general insurance sector as well, especially with three different segments forming majority of the business for general insurance companies. These three segments are motor insurance, health insurance, and property insurance. Essentially, the regulator wants to bring in long-term insurance policies in all these three motor, health, and property insurance segments. A 21-member working committee has been formed. Now, this working committee has representation from the general insurance industry, from the regulatory side, from the banking side, and this committee essentially is expected to give its recommendations and suggestions to the insurance regulator in terms of what could be the structure, how would the long-term products in all these three segments work, as well as what could be the pricing mechanism and accounting mechanism as far as these long-term motor, health, or property insurance is concerned. As far as, the one very clear advantage for insurance companies that this would bring is that it would bring them sticky policy holders staying with one insurance company for a long term. The possible indication from the industry is that there could be 10-year motor insurance policies, health insurance policies, and property insurance policies, and on the motor side, both on the own damage as well as third-party insurance policies. This committee is expected to give recommendations to the regulator. Once that is collected by the regulator, then final regulations will be formed in terms of how these products could look like.
All right, Yash, thanks so much for getting us all those details. But in the meantime, keep an eye out on the market movement as well. At the moment, it's a lot of yo-yo in terms of the movement, in terms of the recovery as well. In fact, Bank Nifty now 0.3% down. Keep an eye out on Reliance Industry, big boy. That movement, low point of the day, and a lower bottom that has been really built on that particular counter could really impact the movement as well as the recovery trajectory. At the moment, Nifty 50 sitting with 16,985 levels. Let's also get you some developments coming in from the auto sector now, and Tata Motors that launched the electric vehicle variant of its popular hatchback Tata Tiago. Now, the auto giant already leads the electric vehicle segment in the country with models such as Tata Nexon EV and Tata Tiger EV. Now, upon launch, Tata Tiago will also become the first premium hatchback to be offered as an EV in India. And we'll stay with the auto sector. An important point that needs to be focused on is ensuring safety for everyone, rich or poor. That is the word really coming in from Transport Minister Nitin Gadkari. Speaking exclusively to my colleague Parikshit Luthra, he says that it is time that the electric vehicle industry becomes more quality-centric and not cost-centric. Take a listen.
These testing norms, they are actually for the people interest. Because of the cost economics, some of the people are doing the material is not up to the standard. So by concerning the engineering faculty, IITs and other people, our expert committee, international standards, on the basis of that, we have fixed up the norms. Still we are open. Every time we discuss with the industry. But my suggestion to the industry that we should not compromise with the safety of the people. And this is not good. You can charge 10%, 5% more for that. But it should give good quality. And that is the reason I feel that it is in the interest of the industry that they should be quality-centric, not cost-centric. Either it is the poor people or anybody, we have to protect the life of the people. That is very important. And we are not going to compromise with the economic model or any model. We have to save the life of the people is the highest important agenda for all of us. It is in the process, and we will try our level best to take it as early as possible. We will issue the order.
Okay, let's get on to some more policy updates now. The government has extended the Pradhan Mantri Garib Kalyan Anna Yojana or the PMJKAY scheme for another 3 months. Remember, this is the 6th time the scheme has been extended since it was started in 2020.
And an important development there, the latest coming in from the NSE co-location scam case. Well, the Delhi High Court in the latest has granted statutory bail to former NSE CEO Chitra Ramakrishna and also former NSE co-group operating officer Anand Subramanian. In a status report filed in the bail plea by Anand Subramanian, well, the CBI said that the probe has revealed that Ramakrishna abused her official position at NSE to illegally appoint him as the chief strategy advisor, and also CBI is probing the alleged improper dissemination of information from the computer servers of the market exchanges to the stock brokers.
All right, let's take a short break now. When we return, we get you an explainer on the RBI's tokenization norms and its objectives as well. Stay tuned.
Welcome back. You're watching Business Lunch. Now, it's the RBI's latest attempt towards safeguarding online payments for the customers. Now, effective 1st of October, well, Reserve Bank of India's card on file tokenization rules kick in. And while it really protects the customers' data, small businesses fear some disruption in the near term until the systems really stabilizes. In fact, our colleague Ritu Singh joins in to explain what these rules mean for all of us.
The way you transact online using cards is about to change because starting October, merchants will no longer be allowed to store customers' card data as the new card-on-file tokenization guidelines come into force. Now, this is effectively RBI's idea of safer online payments. Tokenization, it refers to replacement of actual credit or debit card data with an alternate code, which is called a token, that is going to be unique for a combination of card, token requester as well as device. Now, these tokens can be used for online, mobile POS or in-app transactions by customers. Now, this is not going to be mandatory for you to do. Customers can choose whether or not to get their card tokenized. If not tokenized, then starting October, you'll simply have to enter the full card details every time you make an online transactions. There'll also not be any charges that are applicable for tokenizing your card, which brings us to the next bid. How do you tokenize your card? Well, it's quite simple, really. There's just a few steps involved. First, you visit the app or the website where you want to make a transaction. Now, at the payment page is the next step. You select the saved card and provide the CVV, or you enter your card details if it is not already saved. Then you tick mark the checkbox which says secure your card or save card as per RBI guidelines. And once you enter the OTP, you get a confirmation that your card is tokenized. Now, is it really safer to tokenize your card? To understand that, picture this. Currently, if you're shopping online, let's say booking a travel ticket, you are required to key in your 16-digit credit or debit card details along with your 3-digit CVV number with the travel merchant. The travel merchant then saves this data on its website with your permission so that the next time you use it, you can quickly enter your CVV and OTP to complete the transaction without having to enter that 16-digit card number. Now, this data storage on websites is what could make the customers vulnerable to any online hacks and frauds. A tokenized card, again, there the transaction is considered safer because the actual card details are not shared with the merchant during the entire transaction process. Your card details are only saved with the bank and the authorized card networks like Visa, MasterCard, etc. because RBI has told merchants to create a token reference number against each token, and only these reference numbers are stored by the merchants. Now, once a fraud is detected, for instance, the same token cannot be used and you can generate a new one. Now, while this sounds like a win for customers, in the immediate future, it could disrupt some of the small businesses because the entire system has to upgrade to comply with tokenization rules, and there could be some challenges with tech hurdles initially until the system stabilizes. To begin with, APIs that allows software and services to interact with each other and help verify and pull up data, that needs to be ready, and this has to happen both at the bank and the card networks end first, and only once they are ready can merchants certify the processes. Now, merchants have already voiced concerns that the entire chain is not ready yet, and therefore they believe recurring payments may be the most impacted. Merchants will also have to ensure that all the customer data that they already have stored, which is not always in a single database, has to be deleted. And for smaller merchants, this could mean a temporary loss of customers as they invest in the software and achieve compliance. But ready or not, come October, and the system has to adopt to these new rules.
Ritu, thank you so much for making sense of these new rules which will kick in from October. And with that, it's a wrap on this edition of Business Lunch. Do stay tuned. Mid-Cap Radar comes up next.